That's right. Remember that China kept its very strict controls going a lot longer than other countries, and they kind of collapsed at the end of last year, the beginning of this year. And for a couple of months, we saw some pretty strong spending and strong commercial activity, and people were talking about China roaring back to life, driving the global economy. But after a couple of months, consumer confidence and also businesses really ran out of steam. And as you say, a softening in the property market, which is where so many Chinese families have put their savings, is really spooking people. And we're seeing people not spending, and we're starting to enter a cycle of declining prices, declining property sales, and that is driving real fears about some very large, very heavily indebted property companies.
To what extent is the economy suffering now because of the pandemic? And what other factors could also be contributing to the downturn?
It's as if the pain of the pandemic has exposed some long-awaited structural problems that have been hidden before. And China's property sector has looked a lot like a bubble, particularly the extraordinary amount of borrowing that Chinese property developers do, the way that they sell apartments before they've been completed, bank that cash even as home buyers are starting to pay the mortgages, and use it to build the next project. And as long as house prices kept rising, that looked like a model that could keep going. But now things are soft. Now people are worried about the value of their home. People aren't queuing up to buy new homes. It's exposing some really terrible problems. And some of the largest property companies in China, with hundreds of billions of dollars in debt, are now starting to fail to make some payments to their bondholders. And that is really driving attention to the fact that across the board, some of the economic indicators are starting to flash quite brightly red.
Well, with the property sector in crisis, Guangzhou is the first major city to take significant steps to try and make it easier to buy homes.
We're seeing a whole range of incentives from local governments in cities to, loosen the definition of who's a first-time buyer, who can get an easier mortgage. We're seeing little tweaks to interest rates, nothing very dramatic. All of these measures, we expect to see them continue. But the problem is making it easier to buy an apartment only works if people are of a mind to buy in the first place. And if they're actually too scared to enter the housing market, then these measures look like too little to really address the core problems.
So what other measures do you think might be introduced, and will cities such as Beijing, Shanghai and Shenzhen follow suit?
I think the housing market is a really painful problem for the government, because one of the reasons that things are now slowing down so fast is the government saw a real problem, which was a very bubble-like housing market driven by a tremendous amount of debt. And they started to make it harder for those giant property developers to just go back and back to the banks time and again to borrow more money. And it wouldn't be a particularly smart idea to reopen the taps and reinflate that bubble. But in the meantime, if you're looking at other indicators like rising youth unemployment, the government, instead of addressing this by really driving business confidence, has done things like simply stopped publishing the youth unemployment numbers and has been scolding analysts and bankers to only report good news and stop talking down the economy. So it looks like a party that is starting to see China's miracle economy really sputter in ways we haven't seen for some time. And it's responding with a kind of heavy hand of censorship and scolding rather than the kind of measures that might actually encourage households to go out and invest in the future.
Meanwhile, China Evergrande Group is at the centre of the property crisis. It's the world's most indebted property firm and has lost more than 99% of its share market value over the past 3 years, as I understand it. Its share price continues to plummet.
It's been a brutal ride for investors in Evergrande. As you say, it's horribly indebted, billions in the red. Its share trading was suspended for a year and a half on the Hong Kong stock market. When it resumed yesterday, it promptly fell by 87% in a day. But it's not the only property giant in trouble. There's another enormous company, Country Garden, down in the south of China in Guangdong. And that is also failing to make bondholders, trying to negotiate with some of its creditors to see if it can pay them back a bit later. But that is $200 billion in debt at least, and is also the builder of a lot of properties that have not been completed. So there are a large number of Chinese families now paying the mortgages on properties that are still an empty concrete shell.
What hopes are there for a turnaround for these companies, and how vital are they to the rebound in China's economy if that eventually happens?
The Chinese Communist Party has some astonishing resources at its disposal. It can make Chinese state-owned banks extend a lot of money, and I think you'll see a lot of pressure, certainly to build and finish those apartments that have been paid for, that needs to be delivered. But after that, you're looking at more structural problems about whether China's easy years of growth have ended, and whether the Chinese government's traditional response to trouble in the economy, which was pouring concrete, building all those impressive high-speed train lines, new airports, new highways, which was a tremendous, boon to infrastructure. This is a very modern country in many ways now, but there are only so many airports that a country needs, and they've poured a lot of concrete in recent years. And there's a real fear that the one thing that they need to do, which is restore just the confidence of ordinary Chinese, it's very hard for even the toughest dictatorship to order people to cheer up and be willing to spend.
So for the foreseeable future then, do you think consumers will continue to cut back more on spending?
I think a lot of it is going to rest on the job market, and particularly the youth job market. We're seeing, it's not hard to meet ordinary Chinese who will tell you that their child just graduated from university. They're really worried that they won't be able to find a decent graduate job. Maybe they should go back and try and get another degree, but is that worth it? You're seeing state media kind of scolding young people and saying, don't be so stuck up. Maybe you should do a less grand degree, a less grand job that doesn't need a university degree. But that falls pretty sort of hard on the ears of families that have invested so much in educating their children. There's a real sense that for particularly young Chinese who have only ever known a rising China and a growing economy, now is the first time that they've realized that what goes up can come down, and that China isn't immune to the problems facing other countries. And we're entering a spiral of falling house prices, but also falling prices in other sectors. And that might seem fine if you're worried about inflation where you live. But of course, the problem with falling prices is it's a real reason not to buy that new TV, that new fridge, if you think it's going to cost less in a few months or next year. And if everyone stops spending, then you could enter what economists call a deflationary spiral. Add that to a falling housing market, and you can get yourself into a lot of trouble quite quickly.
Really interesting. David Rennie from The Economist. Excellent to talk to you. Thank you.
Thank you.